Hello friends, welcome to learning sessions and good evening to all of you. Today in this video we are going to study about the second chapter from the BFM, and that's related to the risk and the banking business. We have already covered some part related to it, but there was some video issue yesterday, so we are going to cover the topic that we left in between. Please do confirm the audio video quality at the earliest so that we can proceed. Do confirm the audio video quality at the earliest so that we can proceed. The class will be available for the premium members after the live session only, and right now the class will be available for all. And if you want to get the PDF file of this particular video, you need to download our application, which is available at the link iibf.info/app. Right, so we were previously discussing about the risk management, and this is the module B of the BFM, and I've already conveyed the idea to you that the module B is the most important module for the BFM, right? So in the last video we learned about the banking business lines, and I told you that the banking business lines are actually grouped as the banking book, the trading portfolio, and the off-balance sheet exposure. I told you about the banking book. In case of banking book, if we gonna basically go through it once again, it follows the accrual basis accounting, and moreover whatsoever the advances, deposits, borrowings, those all are there, and those are HTM basis, that is held till maturity basis. We are going to hold the particular securities, assets, we can say, our deposits, we can say, our borrowings till maturity, right? And different types of risks are there, like the liquidity risk is there, interest rate risk is there, default risk is there, operational risk is there, right? That was the case. And after that, the second one, it's related to the trading book. Trading book is basically related to the assets which are marketable, which can be traded on the market, right? And normally these are MTM basis, that is mark to market basis. You're not going to hold these assets till maturity, right? You'll be liquidating your positions whenever you'll be getting a profit opportunity. So that is the case related to the trading book. And the most prevailing risk in case of the trading book is the price risk. I already told you. And we also say the price risk to be the market risk. Market risk and the price risk is the same thing. The risk which is imposed due to the adverse movement of the market prices, it is a market risk or the price risk. And it may also be the case that you are investing into such assets in which you basically feel the difficulty to liquidate them due to the lower market demand. So that may lead to the liquidation risk. So it may impose the liquidation risk on you, right? And further, there can be a default, there can be a credit risk imposed to you by the counterparty if the counterparty is not keeping up with the commitment. In that scenario, if they fail to do so, then it will be leading to the default risk or the credit risk, and definitely the operational risk may be present there, right? So these are the different risks which are present, and the most prevailing risk is the market risk. And in case of the banking book, the most prevailing risk was related to the liquidity risk, right? So that is a difference between these two. Is that clear? And after that, the third one, it's related to off balance sheet exposure. I already told you about the off balance sheet exposure. Off balance sheet exposure is not related to such assets or liabilities. It is just related to the contingency receivables. It could be related to the part that you are to receive the receivables, but in future, and those are contingent. You may be receiving them, you may not be receiving them, and it may be the case on an obligation may be arise on the bank, like in the case of the bank guarantee, in case of the letter of credit, in case of the co-acceptance letter. The bank is having the obligation that if the undertaking is not fulfilled, then there will be fund flow, otherwise there is no cash flow involved. If everything is working all right, there is not any risk in that, but it may be a situation that the risk may arise, right? So it is non-fund based facilities which may get converted into the fund based facilities these are contingent in nature, right? Like the bank guarantee is there, credit lines are there, letter of credit is there, co-acceptance letter is there. Other than that, there are many derivative instruments which are off balance sheet market exposures, like swaps, forward contracts, FRAs, forward currency contracts, options, etc. These all are the derivatives. If I tell you about the derivatives, derivatives are not having the value of their own. They basically get induce the value from the underlying asset, right? So off balance sheet exposure does cover all. So all types of risks may be there. These particular assets or these particular exposures may be based for HTM basis, held till maturity basis, or maybe MTM basis, right? So all the risks are imposed in case of the off balance sheet exposure, which were there individually in case of the banking book and the trading book. Like liquidity risk may be there, the interest rate risk may be there, market risk, default risk, operational risk. So all the risks that we read in the previous 2 points, those all may be imposed in case of the off balance sheet exposures. Is that clear? After that, now let's have a look at the anatomy of the bank's business. Let's just have a look at it, right? You'll be able to understand them well. Further, first of all, the banking book will be covering the assets, and further those particular deposits and all the things which are there for HTM basis, held till maturity basis, and accrual basis accounting will be used. Whereas in the case of the trading portfolio, these are actively traded marketable securities or marketable assets that you're having with you, and you're not going to hold them till maturity generally, right? You'll be having them on MTM basis, mark to market basis. So whatsoever the profit or loss, that will be transferred to your profit and loss account on daily basis at the day end, that will be that will be given to you, that will be awarded to you, right? And the third one, it's the off balance sheet exposures. These are the contingent obligations. These could be the derivatives, right? And these may impose and every kind of risk which is imposed individually in case of the banking book or the trading portfolio. Is that clear? Now let's move further. It's related to some definitions related to the risks. First of all, what is liquidity risk? Liquidity risk is related to, let's say, the case that you are having an obligation so as to pay the amount, but you're not having the funds with you right now. That is a liquidity risk. That is the liquidity risk. So liquidity risk is basically the inability to obtain the funds. So if we are going to talk about the liquidity risk, we are having the multiple types of the liquidity risks, right? One, it is related to what? Let's take the case when you are when you are funding the long-term assets by the short-term liabilities. When we are funding long-term assets by the short-term liabilities, it may impose what risk? It may impose the liquidity risk. How come it is going to be imposing the liquidity risk? Let me just give an example. Let's take the case that you have given a housing loan for 20 years of the tenure. For 20 years of the tenure, you have sanctioned the housing loan, and you are having the FDR for 5 years. Now your FDR is going to mature after 5 years, whereas your loan will not be fully paid after 5 years. So you are to replace the net cash outflows, right? Because after 5 years, the person may renew the FDR or person may not renew the FDR. In that scenario, we are to do what? We are to replace the net cash outflows, and that's a risk which is imposed, which is what risk? Which will be the liquidity risk which will be imposed, right? And liquidity risk is of multiple types, of different types. One, it is related to the funding risk, when we need to replace the funds, right? When you're out of funds, it could be related to the unanticipated withdrawals, or it could be related to the non-renewal of the deposits. So that will be what? That will be the funding risk. Other than that, the second type, it's related to time risk, that you were supposing that the person will be doing the repayments in time, but there was some delay, and that particular risk arises when you need to compensate for the non-receipt of the expected cash inflows. You were basically expecting that the cash inflow will be there. You were expecting that the borrower will be paying the monthly installment, but the borrower is not paying the monthly installment to you. There was a performing asset which is now converted into the non-performing asset. In that scenario, there is non-receipt of the expected inflow, and that will arise that you need to compensate for that non-receipt of the expected inflow. That is the time risk. The third type, it's the call risk. It's the call risk. Now the call risk arises due to the crystallization of the contingent liability. Like I told you, in the case of the off balance sheet exposures, what happens generally? What happens generally in case of the off balance sheet exposures? That your contingent liability crystallizes. There was a bank guarantee which was given by the bank, and that crystallized, that the bank is now to compensate the particular beneficiary, right? So that will be what? That will be the call risk. That will be the call risk. So first one, it's related to liquidity risk. As I told you, it's about the inability to obtain the funds, and I told you about the types of it, like funding risk, time risk, and the call risk. Funding risk is related to when you need to replace the net cash outflows due to the unanticipated withdrawal or non-withdrawal of the deposits, first case. And the second one, it's related to the time risk when we need to compensate for the non-receipt of the expected inflows when your performing assets does convert into the non-performing asset. And the third one is the call risk that arises due to crystallization of the contingent liabilities. Is that clear? So that's about the liquidity risk. Other than that, the second type, it's related to the interest rate risk. Let me just tell you on the whiteboard over here. The second type that we are going to cover is the IRR, or we can simply say it is a interest rate risk. Now the interest rate risk may be there when the interest rates movements are in adverse scenario. You want the interest rates to go up, but those are going down. You want the interest rate to go down, but they are going up. So that's a adverse scenario, not favorable to you, right? So it's going to impact the bank's earning, or it may be having the impact on the value of the assets, or the value of the liabilities, or value of the off balance sheet exposures, right? Now we need to understand one particular part. We are having the risk sensitive assets and the risk sensitive liabilities. Now both may hurt you. Both may hurt you. Let's say case when we are talking about the risk sensitive assets, it means we are talking about those loans or those investments where the interest rate may alter. And when we are talking about the risk sensitive liabilities, we are talking about the borrowings that we have made. We are talking about the lending. We are talking about the amount that has been placed by the borrowers or by the customers, by the depositors, right? That is a liability. Now, if the underlying rate of interest is going to alter, it's going to basically become a headache for us. Let me just quote you an example. Let's say in case of RSA, we were earning 10% of the interest, and in case of RSL, we were paying the interest cost of 6%. Now, what if the RSA interest rate reduces? Let's say it's reduced to 9%. Our net interest income will be reduced to 3%. Previously it was 4%, but now it is reduced to 3%. On the either way, it could be their case that the RSA interest rate is all same to be 10%, but the interest rate on the RSL, that is a risk sensitive liability, increased. Now it is 7%. Same way, the net interest income will be now reducing to 3%, right? So that is the case that we want to discuss about, right? So interest rate risk is the adverse movement of the interest rate, and it may impact the bank's value, bank's earnings, bank's economic value related to the value of the assets, liabilities, and even the off balance sheet positions, right? Now let's discuss the different types of the interest rate risk. First one is the most important one, and that is the gap risk. That is the gap risk, and we also name it to be the mismatch risk. We also say this risk to be the mismatch risk. Now what is gap risk or mismatch risk? Let us take the case that you're holding the assets, you're holding the liabilities, right? The bank is having the bouquet of the asset, bank is having the liabilities with it, bank is also having the off balance sheet exposures. But let us take the case they are having the different principal amounts, they are having the different maturity periods, they are having the different repricing dates. In that scenario, if there is an unexpected changes in the level of the market rate of interest, definitely the exposure may be exposed to some kind of risk, right? So I'm talking that there may be differences related to what? It may be the difference related to the principal amount. It could be related to the different maturity dates, or it could be related to the different repricing periods. Let's guess your assets are repricing quarterly basis, but your liabilities are repricing on monthly basis. Definitely it may create an exposure. If the movement is adverse movement, definitely it's going to create an exposure on you. That is what, that is a base, that is a gap risk or the mismatch risk. The second type of the interest rate risk, it is the embedded option risk. It is a embedded option risk. Now, what do you mean by embedded option risk? Definitely, when you are extending a loan facility or you are extending a demand loan, definitely it's a probability that the prepayment may be there. It may be the case that the prepayment is there, that the loan is prepaid, right? And when you are basically issuing a FDR, there is a possibility, that the depositor may be withdrawing the amount premature basis, right? In both of the scenario, there is an option which is available. There is a right which is available to the borrower, to the depositor, right? And that may impose a risk on the bank, because that will be an uncertainty that the customer may prepay the amount, or the depositor may premature with having the premature withdrawal of the FDR, of the term deposit. So that's the embedded option risk, because that's an embedded option that's available with the facility that you're extending to the borrower or the depositor. The third type, it is a reinvestment risk. The third type of the interest rate risk is a reinvestment risk. Now, there is a general assumption related to the point that, let's say the case that we extended a loan at 11%, right? And we thinking that we are going to earn 11% of the return upon it. But when the repayment will be starting, right, the borrower will start repaying the amount to the bank. It is assumed that whatsoever the amount is repaid to the bank will again be reinvested at the same rate of interest, which is not possible somehow, sometimes, right? So whatsoever the repayment the bank received, so it's not possible always that the bank is going to reinvest them all cash inflows at 11% again. It may be the case that the bank may reinvest the amounts at a lower price or the lower interest rate. So that particular risk would be what? That will be the reinvestment risk. That particular risk is a reinvestment risk. Other than that, one type that we are having over here, it is a basis risk. It is a basis risk we are having the type over here. So in case of the basis risk, what happens actually? The basis of the interest rate based upon which the interest rate is calculating is in the adverse movement. Let me just quote you an example. Let's say case whatsoever the interest is being paid on the asset, or whatsoever the interest rate that is being charged on the liabilities, they may change in the different magnitude. They may be changing in the different magnitude, and that is what, that is a basis risk, right? So that type is the basis risk, and that will be what? That will be the fourth type of the interest rate risk. Last but not the least one, it is the yield curve risk. Yield curve risk. Let me just give an example related to it. We are having the treasury bills with us, and treasury bills are issued for the different maturities, for 91 days, for 182 days, for 364 days. right? Now these treasury bills, they belong to the same category, but due to the different maturities, they are having the different yield curves. Now let us take the case, one of the asset is based upon the 91 days of the treasury bill, and your deposit is based upon the 182 days of the treasury bills. In that scenario, the risk which is imposed is not due to the different underlying asset or different underlying benchmark, but it is based upon the different yield curve. So that is what, that is a yield curve risk, right? So we are having the 5 types of the interest rate risk: gap risk or the mismatch risk, embedded option risk, a reinvestment risk, basis risk, and the yield curve risk. I hope that you must have understood them all. Kindly please confirm that if you have understood the points over here so far. And if you are liking the video so far, kindly do give this video a thumbs up. Do like this video and do share this video among your friends and colleagues. So let me reiterate the interest rate risks over here. The first point that we read about, that was a gap or the mismatch risk that may be arising because you are holding different assets, liabilities, off balance sheet exposures, which may be of different principal amounts, different maturity dates or the repricing date, and exposure may be there, which is a gap risk or the mismatch risk. And basis risk is related to interest rate risk, which is imposed on the different assets, liabilities, and the off balance sheet exposures, because the underlying benchmark may change in the different magnitude. Your asset is based upon LIBOR, your interest rate is based upon repo, right? Now those may be changing in the different magnitudes, and that may be imposing a risk. Let's say case the LIBOR reduced by 1%, but the repo just reduced by 0.25%. Now your net interest income is reduced, and that is what, that is a basis risk. Yield curve risk, let's say case when the bank is using two different instruments maturing over the different time horizons but based upon the same benchmarks, so there may be a non-parallel movement of the yield curves, which may be leading to the lesser NII, and that will be due to the yield curve risk. Fourth one, the embedded option risk. There is a possibility which is available. There is a right available to the depositors and further the borrower. The borrower may be prepaying the loan amount. The depositor may be having a premature withdrawal of the deposits, right? That will be the risk imposed upon the bank. That is the embedded option risk. And the fifth one, not the last one, that's the reinvestment risk. Reinvestment risk is related to, we are assuming that whatsoever the cash inflow is there when the repayment will be made, that will be reinvested at the same rate of interest, which may not be true all the same times. So there is an uncertainty related to it, that is a reinvestment risk imposed. Is that clear to you? Kindly confirm with a smiley or yes in the chat box. Okay, so let's move ahead now. Further, it's related to the market risk. Now there may be the adverse movement of the market. The prices may be moving in the adverse direction. That will be what? That will be the market risk. What risk will be imposed? It will be the market risk which will be imposed due to the adverse deviation of the mark to market value basis. That may be having a very bad impact on your trading portfolio due to the adverse movement. Let's take the case we purchase the gold or silver today. We purchased the gold or silver today and the prices were not favorable. We purchased, let's say, silver at 2,46,000 per kg, and that is now reduced, let's say, to 2,20,000. Now overall what happened? Overall our income reduced due to the adverse movement of the market. So that is the market risk, and we also say it to be the price risk. Market risk or the price risk is one and the same thing. One and the same thing, right? So price risk occurs only when the assets are sold before their maturities. Only if the assets are sold before their maturities. Then it's related to the forex risk or the exchange risk. Now that is the subtype of the market risk. Why so? Because definitely if the exchange rate is moving every single second, the exchange rates does change, right? Now if the exchange rates are changing, in that scenario there is an open position to you. What is open position? What is open position? Let's take the case that your bank has purchased 10,000 USDs. That is an open position. The bank bought or bank buy 10,000 USDs, and on the other leg the bank sold 8,000 USDs. Okay, so bank basically is in the contracts of buying 10,000 of the USDs and sold 8,000 of the USDs, but still the bank is having the overbought position. Overbought position, we also say the overbought position to be the long position. Overbought position is a long position, and if the selling leg is more one, we say it to be the short position. So whenever there is a long position or the short position, it is said to be an open position, right? So if the open position is there, in that scenario definitely the risk will be imposed, because there is movement of the exchange rate every single second, and it may be a adverse movement to you, and you may be lost some money, right? That is what, that is a foreign forex risk or the exchange risk. Further, the other type of the market risk is related to the market liquidity risk. It is market liquidity risk. Let's take the case that you're having an asset which you can be selling in the market, which is priced in the market at rupees 100, right? But when you go to the market so as to sell that particular asset, you're not able to sell that asset. You're not able to conclude that transaction. It may be a large transaction due to which you're not able to conclude near the current market price. So that is what, that is a market liquidity risk, that you want to sell it at the market price, but you're not able to conclude the transaction at the same current price. That is what, that is a market liquidity risk when it will be imposed. Is that clear? Other than that, now let's discuss the market risk again. The adverse deviation due to the mark to market basis, that may be having a very negative impact on your portfolio, that is a market risk, also said to be the price risk. And price risk occurs when you are going to sell the assets before the maturities. Forex risk I told you all about, and market liquidity risk we discussed in detail. After that, it is a default risk or the credit risk. When you're extending a loan facility and the person never pays the money back or makes a default in that particular case, that is the default risk or the credit risk. When the counterparty fails to fulfill the obligation, right, that is what, that is the default risk or the credit risk. And it may also be the counterparty risk. Counterparty risk is related to what? The risk which is imposed due to the non-performance of the trading partners, because the counterparty refused to fulfill their obligation, right? That is a counterparty risk. So counterparty risk is a subtype of the default risk or the credit risk. First type. The second one, it's related to country risk. Now country risk is the one risk which is not imposed due to the counterparties. It is something bigger than that. Let's say case A is in India and B is in Pakistan. A is in India and B is in Pakistan, and both want to fulfill their obligation. They are committed to fulfill their obligation. But let's say the case that the Pakistan has put some imposed some restrictions related to trade, related to transactions, and now B is not able to conclude this transaction. B is not able to fulfill their obligation. Now the risk which is imposed is not due to the counterparty, but it is imposed due to the country. The risk which will be imposed in that scenario will be country risk and not the counterparty risk. Again, it's a default, so it will be the subtype of the credit risk or the default risk. Is that clear? Now, again, the other type one, it's related to the operational risk. Operational risk is the risk which is imposed due to the inadequate systems, frauds, internal frauds, people, external systems or external events. Like even if there is any external calamity is there, fire is there, right? That is also amounting to the operational risk. That is a operational risk. So further, it's related to the transaction risk. That's the subtype of the operational risk. Subtype of the operational risk. Now in case of the transaction risk, the risk which arises due to the fraud. It may be the internal fraud, it may be the external fraud, it may be the case that the business processes are not working as required, it may be the inability to maintain the business continuity or so as to manage the information. That is what that is said to be the transaction risk. So if it is due to the working halt, right, the working halt, it may be due to the fraud, it may be due to the processes, it may be due to some inability, it may be due to the so as to manage the information. That is what that is a transaction risk. And when the integrity is breached, when the integrity is breached, you're not going to comply with the regulatory authorities, right? You're not going to comply with the law, right? That would be what? That will be the compliance risk. That will be the compliance risk. And this compliance risk may lead to the financial loss. It may lead to the reputation loss even, right? It may be due to this. So whenever the bank is failing to comply with the applicable laws, regulations, standards, right, the risk is imposed, which is said to be what? Which is said to be the compliance risk. Then it is related to strategic risk. Strategic risk, when you are having a very bad strategy, improper implementation of the decisions, you are not responsive, right, you are making bad decisions, that is a bad strategy, that is a strategic risk. And the risk which are there, which may arise there due to negative public opinion, when the public has lost their trust in the bank, right, that is the reputation risk, and it may expose the bank to the litigation. The bank may face a financial loss, the bank may face that there is a decline in the customer base over there. That would be what? That would be the reputation risk, right? So these all are the different types of risks. These all are the different types of risks. Are you able to understand them all? So we read all about the liquidity risk. In case of the liquidity risk, I told you about the types. Like I told you about the funding risk. There are unexpected cash outflows or non-renewals of the FDR. It may be the time risk that you're expecting so as to receive the money, but the performing asset was converted into non-performing asset. The contingent liabilities may crystallize, that will basically giving rise to the call risk. The other one, it was related to interest rate risk, where we are having the type related to the gap risk or the mismatch risk due to the different maturity or the repricing dates of the assets, liabilities, or the contingent liabilities, right? Basis risk may be there when the different benchmark rates are associated with the assets and liabilities. Yield curve may be there when you're having the assets to different assets from the from the different let's say for the same benchmark, but different time horizons, right? In that particular scenario, non-parallel shift in the yield may be there, which may lead to the yield curve risk. And further, it could be the embedded option risk, and also it could be the reinvestment risk. One type which is not mentioned over here, that is a reinvestment risk. Let me just mention over here. Further, default risk, that is due to the non-repayment, it may be the counterparty risk or the country risk. Further, it's related to the operational or compliance risk like a transaction risk or the compliance risk. Operational risks are there, and other risks are strategic risk and the reputational risk. And if we talk about the market risk, it is due to the adverse movement of the market prices, which may impact the value of your portfolio. It could be the forex risk or exchange risk or the market liquidity risk. I hope that you must have understood each and every point related to it. I made you understand each and everything with an example. So if you have liked the video so far, kindly give this video a thumbs up, and that would be the end related to the second chapter of the banking financial management module B. And in tomorrow video, we are going to start with the module B, chapter number 3, and that is going to be very much important because that is related to the Basel III norms, right? We can start the chapter today. And we'll be keeping it up with the in the next video also, right? So let's start the chapter over here. So the next chapter, it's related to what? It's related to the Basel III, that is related to risk regulation in the banking industry. It is a risk regulation in the banking industry. Kindly pay attention to what this chapter, very much important. It's not difficult at all, but you should be paying attention toward it. So let's understand them all. First of all, why the regulations must be there? Because we want to improve the safety, that is to be done, right? And common benchmarks must be there, because if we are to basically deal in international space, then definitely there should be the benchmarks which must be common for all the players, so that there can be a level playing field, right? So level playing field should be there, that's very much required. Further, so as to promote the sound businesses and supervisory practices, and further protecting the interest of the depositors, because there were so many risks which are imposed, whether we are talking about the great deep depression or the global financial risk over there, right? So all the things were there, and definitely there is also the systemic risk which is present. Now, what is systemic risk? First of all, understand the systemic risk. Now, let's say case there are different entities. There are different entities. One is in Japan, one is in USA, one is in India, one is in Israel, one is in some other country. Now these are highly interrelated or highly interconnected network, because one has lent money to the other has borrowed money from one, so they are very much interconnected with each other. That is a very first point, right? So these interconnections or interrelations, those interrelations are on ongoing basis, and the failure of the single individual entity will be leading to the failure of the other entities over there, right? And that risk is said to be what? That is said to be the systemic risk, not systematic risk. It is a systemic risk. So if the single particular bank generates a risk of the failure of all the banks, definitely the risk which will be imposed, that will be the systemic risk. And systemic risk is actually going to be a very major challenge for the regulator so as to manage, right? And there are some updates related to it. We'll be discussing them also, like DSIB is here. Domestic systematically important banks are there. In India, there are 3 banks which are under the DSIB category, and there are different buckets for the same, and they are to maintain the extra capital also, right? We'll be discussing all the things further. After the systemic risk, actually on June 1974, there was actually number of banks that had basically released a dish marks to the bank Herstatt in the Frankfurt in exchange of for the dollar payments. So we are going to first of all talk about the Herstatt risk, or we also name it to be the temporal risk. We say this risk to be the Herstatt risk, or we say such risk to be the temporal risk, right? And this risk was there imposed due to the different time horizons, due to the different time zones. Now one country is in the earlier time zone and the other country is in the later time zone, right? Now there was a commitment between these two, there was a contract between these two, and the country in the early time zone made their payment. But when the day opened in the later time zone, that particular bank who was to fulfill the obligation, that became bankrupt, and the whole system went down, right? That is why it is named for that particular bank, that is a bank Herstatt, to the Herstatt risk. There was bank Herstatt because the dash marks were released to the bank Herstatt, and the bank Herstatt failed, and that is why it is said to be what? It is said to be the Herstatt risk or the temporal risk. Now that particular incident prompted the group of 10 countries that they formed the BCBS. In the end of the 1974, they formed the BCBS, that is a Basel Committee on the Banking Supervision, right? And that was under the BIS, that is a Bank for International Settlements, right? So there were the central government, central banks from the different countries, or we can say different regulators from the different participating countries, and the first accord was given. Now accord is basically the, we can simply say, the rules regulations which will be the voluntary rules regulations which must be followed, right? So it was mandatorily for the member banks that they are to follow these accords. So there were deregulations in 1988. Now definitely the competition was there, and there was increasing the risks of ban over there. So Basel Committee published the minimum capital requirement, and those minimum capital requirements were published in the year 1988, which is known as the first Basel Accord. Right now the Basel III accords are prevailing, right? But we are talking about the history first of all, and those were enforced by the G10 countries in 1992. The first version came there out in 1988 and was enforced by the law by the G10 countries in 1992, and they put a framework related that the banks are mandatorily they are to maintain the minimum capital required, and the capital which was required to be maintained, that was linked to the credit exposure only. Previously that was linked to the credit exposure only, and in 1996 only there was amendment related to it that the capital is also to be maintained for the market risk. They basically BCBS, I'm talking about Basel Committee on Banking Supervision, they published the amendment to the 1988 accords that the capital cushion which was to be maintained for the credit risk is now also to be maintained for the market risk, right? And RBI issued the guidelines to the bank in 2004 related to maintenance of the capital for the market risk. Previously it was not there for the Indian banks. In June 2004 only RBI issued the guidelines that we need to maintain the capital for the market risk also. And after the Basel I Accords, there was a revision which was passed, and they said that the capital that we are going to maintain under the Basel I Accords is not sufficient. It is not risk sensitive. It is just a thing that you need to maintain 10,000 crores, you need to maintain this percentage, this percentage. Every single entity, every single bank may be having the different magnitude of the risk associated with it. And it should be the case that based upon the profile, based upon the risk sensitivity, the capital must be maintained. That must be there. That it should be done in that manner, right? So it basically prompted and also promoted that decision making, that we are to maintain the regulatory capital, but definitely there should be some criteria, there should be some constraints related to it, hard that how this should be risk sensitive capital. And also the Basel one was not able to recognize the role of the credit risk mitigants. It was just like that even if you're purchasing some credit default swap or some collateral, it was not recognizing the same thing. It was basically serving every single exposure as the same exposure, which was actually not the case. So if you're having some credit risk mitigants, overall it's going to reduce the credit risk, and ultimately if the credit risk is reduced, then lower capital should be maintained. Now just think it from the bank's point of view. On one hand, you're basically imposing the rules. On the other hand, the banks are basically helpless because they are not able to maintain the capital because they are to make the profits also, right? That is the scenario. Now if the banks are to maintain the capital and so as to profit, so as to be profitable, they will be trying so as to be profitable, and on the other hand they will be trying so as to maintain the lesser capital. Now that is only possible if the banks are lending in such a manner that they are having the lesser risk associated with them. And banks were actually doing that. The banks were having the securitization, the banks were having the collaterals with them, the banks were having the guarantees with them, which may be reducing the credit risk, but the Basel I Accords were not able to recognize those things, right? So that particular thing was fixed in Basel II Accords. Now further, Basel I Accords were not taking into account the operational risks. That was also a major thing that was to be done, right? So Basel II fundamental things were related to what, that they wanted to strengthen the overall international banking system, right? And further, to not to become a source of competitive inequality, there should be equality related to it, and the banks must be having a capital adequacy system associated, so the banks may be robust. And further, the BCBS further released the International Convergence of Capital Measurement and Capital Standards, which was a revised framework on the June 26, 2004. Right? On June 26, 2004, the new guidelines were released. Those were very much risk sensitive capital requirements, which were taking into account the operational risks also. So there are three types of risks for which the capital is to be maintained. That is a credit risk plus market risk plus the operational risk. For these, we are to maintain the capital, right? And assessment of the risk was highly provided by the internal systems. so that the banks can also be giving the input related to that how the capital is to be calculated, because the banks are the most aware persons that they know that how much risk we are carrying, right? And they should be giving an input, right? They should be giving an input that we are having this much risk, we are having higher risk, or it may be the case that they're having the lower risk, right? And also the Basel II Accords provide a range of options that we can do determine the capital requirements for the credit risk, operational risk, and there are some different approaches available for the same. Every bank is not in the same cup, right? May not fit in the same cup, so there was a different spoon for every cup. So capital requirement under the new accord is the minimum one, and there was provision for the supplementary capital also, which may be implemented or adopted by the national regulator, not a mandatory thing for every regulator. The regulator can decide of their own that if they feel so that in their country the underlying risk may be there and they want to save the economical system, banking system, then they can be putting up so as for the implementation of the supplementary capital, right? And also the Basel II Accords do promote stronger risk management practices, right? So that's the case. So that was a scenario related to it. Now, under the Basel II Accord, there are three pillars. There are three pillars under the Basel II Accords. One, it is related to the minimum capital requirement. It deals with the CAR. It is said to be the capital adequacy ratio. It is also known for some other name, that is CRAR, capital risk weight asset ratio. It is also said to be the capital risk weight asset ratio. CAR is capital adequacy ratio. CRAR is capital risk weight asset ratio, right? And under the pillar 1, the capital is to be maintained for three types of risks: credit risk, market risk, and operational risk. And the risk will be measured and the capital is to be maintained against the risk weight assets of these three risks. Now, what do you mean by risk weight asset? Let's take the case that you have granted a credit card loan. Credit card loan. Now, as per the standardized approach by the Reserve Bank of India, it is given that the risk weight asset percentage for credit card is 125%. So even if you sanction 1 lakh of the loan, the risk weight asset percentage would be 125%, and we calculated it is 1,25,000. Now you have to maintain the capital for not for rupees 1 lakh but for rupees 1,25,000. And also for interbank exposure, it is 20%. Like if you are having a exposure on some other bank to be 1 lakh, you have to multiply it with 20%, that will be 20,000. Now you have to maintain the capital not for 1 lakh but for 20,000 over here, right? So that is the risk weightage percentage, and there are different approaches related to it. We will be discussing them all. I'm just giving you a rough idea related to it. First of all, is this clear to you? First of all, kindly confirm. So we have to maintain the minimum capital, and if we look at the capital structure, we are having the different capital. Like overall capital which is to be maintained is said to be capital adequacy ratio or capital risk weight asset ratio. CRAR is what? It is capital risk weight asset ratio. Clear? So the total CAR is equal to the sum total of tier 1 capital plus the tier 2 capital. The tier 1 capital is said to be the going concern capital. We say such capital to be going concern capital because it is a liquid capital which keep your organization going on. It is a going concern capital, and it is also said to be the core capital. And on the other hand, tier 2 capital, it is a gone concern capital. It is not liquid capital, it is illiquid capital, least liquid capital. And the second name, it's the supplementary capital, secondary capital or supplementary capital we can say. Under tier 1 we are having two types, that is CET1 is composed of CET1 common tier 1 is composed of CET1 common equity tier 1, and AT1, additional tier 1 capital. That is the scenario, right? So under the pillar 1, we have to maintain the capital, that is the CAR, minimum capital is to be maintained, and capital is further divided into two parts: tier 1 capital, which is said to be the going concern capital or the core capital, and the other one, it is a tier 2 capital, that is a going concern capital or the supplementary capital. Tier 1 capital is further divided into two parts, that is a common equity tier 1 capital, CET1, and the AT1, that is the additional tier 1 capital, right? The highest quality of the capital is the CET1 capital, right? Is that clear? Now, the second pillar, it is a supervisory review process. It is SRP. Second pillar is related to SRP, supervisory review process. It is having two components. One, it is related to internal capital adequacy and assessment process. Internal capital adequacy and assessment process, ICAAP. And the other component is SREP, supervisory review and evaluation process. One, it is internal capital adequacy and assessment process, and for the second component is SREP, that is supervisory review and evaluation process. Now under the ICAAP, as the name suggests, the banks must be having some internal model so as to find out that what extra amount of capital that they need to maintain, because the fundamental point is that the capital which is maintained under the pillar 1, that may not be sufficient, because that is the minimum capital requirement which is to be fulfilled. But the banks may be having the different risk profiles, and definitely a risk may be imposed on the bank even after maintaining the capital cushion under the pillar 1. All right, that may be true, right? So for that particular case, there must be an internal assessment process that you're able to match that if this capital is adequate for you or not, or some extra capital is to be maintained by the bank or not, right? And the second leg of this particular pillar 2 supervisory review process, it is supervisory review and evaluation process. What does that indicate? Supervisory review and evaluation process indicate that the RBI, that the regulator, will be looking into your model, will be checking if your model is working all fine, if the capital that you have assessed as at per your end, right, is that true, is it all fine or not, right? That is a SREP, supervisory review and evaluation process. So it will be reviewing your model, it will be evaluating your model, it will be evaluating your process, and if everything is all fine, then all fine, right? So that's the SRP. And the third pillar is a market discipline, and this market discipline pillar, that's going to support the first two pillars. It's going to support the first two pillars. How come? This is related to transparency. The pillar number 3 says the transparency is to be maintained. The information, required information, must be available to the different stakeholders. It should be available to the different stakeholders like employees, creditors, vendors, owners, management, regulators. The information must be available, and most of the information must be shared in the public domain on quarterly or half yearly basis. There is different frequency given for that. So it's in a way going to support the pillar number 1 and pillar number 2. Is that clear? So have you got an idea about the 3 pillars here? Kindly confirm. Right. After that, as I told you, there is under the pillar 1, if we talk about. So first of all, now coming back to the pillar 1. In pillar 1, we are going to talk about the different risks that we are going to cover the capital for. It is for the credit risk, it is for the market risk, it is for the operational risk. Now here are the different approaches which can be used by the banks depending upon the sophistication of the systems or the models. The bank which is more sophisticated can get a right from the Reserve Bank of India that they want to calculate the capital as per this particular approach. And if RBI allows, you are allowed to do so. Like for credit risk, we are having the standardized approach. Under the regulator gives the risk weighted asset percentage to the banks, and the banks are to maintain the capital for the same case. Like I told you, for credit risk, for the credit card, it is 125%. For the interbank balances, it is 20%. For the loans extended to the state government, it is 20%. For the loans extended to the central government, it is 0%, and so on and on. right? We'll be discussing it, the whole table related to it, no worries in that, right? So that is the case. So that is a standardized approach. Other two approaches are the IRB approach. These are internal rating based approach. One it is IRBFA, one it is IRBF approach. Other one is IRBA, IRB advanced approach. Internal rating based foundation approach, internal rating based advanced approach. We will be discussing them all in detail. There are 4 different parameters related to these approaches, which may be calculated at the bank end and by the supervisor, right? By the regulator, right? So we will be discussing these 2 in detail. Further, if we look at the capital for the market risk, we are having the maturity method, standardized approach, duration method, standardized approach, or it could be the internal model method. In exam, you may be asked the question about the BIA, that is a basic indicator approach, the approach for the operational risk, or the standardized approach, that is SA, TSA, the standardized approach we say it to be, and or it could be related to AMA. For AMA, the numerical questions are not available, but for these two, the numericals may be asked to you. And also for the IRBF, the numericals may be asked to you, right? Is it clear for so far? So we are generally what happens, this is a new topic for you. Right now you may not be able to know the things much well, but when we'll be solving the questions based upon it, you'll definitely be getting an idea that what I'm trying to say, that and what we learned beforehand, right? So do not worry about it. I'm going to end the session over here right now, and we'll be covering the rest part tomorrow, right? So I just suggest you that if you want me to cover the one-liners or flashcards based upon it, I'm going to cover the flashcards based upon it so that you can retain it very well, right? So that was all about today video. I hope that you must have enjoyed the content, and if you seriously like the content and if you're watching the video like on daily basis, kindly do give this video a thumbs up, and do not forget to share this video among your friends and colleagues who are preparing for the CAIIB exam 2026, right? This video definitely is going to help them a lot, because this is the most important module under the BFM, Bank Financial Management. So please do cover it on daily basis, and after the live session the class won't be available for the other members and will only be available for the premium members, right? So thank you so much, and see you again in the next video. Happy learning.